Everybody, and welcome to our first annual Urban Communities webinar. My name is Pete Alford, and I spearhead our Investor Relations and Capital Markets group. I'm fortunately joined here today with Taylor Bryan, my colleague on the Investor Relations team. And what we'd like to do over the next 30 minutes is provide everyone with an update on who we are. Some of you don't know specifically what our business model is. We'd like to highlight the multifamily market, and then talk about one of our deals in the making right now, which will be closing in 30 days in Houston. For many of you that have joined as investors, thank you. Thank you for your trust and confidence in us. And for those that are new to the Urban Communities model and ourselves here across the nation and even around the world, we have some dialing in from Canada and in Europe. Thank you. We look forward to highlighting who we are and showing you one of our offerings currently that is open right now. So with that, let's get started. What I'd like to do is highlight who we are. For many of you, Urban Communities is a vertically integrated multifamily real estate firm focused on providing safe and sustainable communities for what we call the gray collar workforce resident. We'll talk about that here momentarily. What we do is we tend to buy off market where we can, for the most part, cash flowing and light value add Class B and C, what those are vintage properties, usually in the 70s, 80s, 90s properties throughout the US. And we're focusing now more on this, what we call the smile states here in the Southwest and Southeast. We focus on purchasing properties that are 150 units and up. And in an MSA, metropolitan area, we like to acquire approximately 1,000 units so that we can scale with our business model. And what we do finally is we provide our investors great returns over a 2 to 3 year period. We don't purchase a property unless we can provide our investors with at least a 20% IRR, that's net annualized IRR, in a 24 to 36 month period. Let's talk about how we began. This concept was started back in 2015, 2016 by our CEO and founder, Max Palacio. Max is Argentinian by descent, economist by trade, and he was working in the large conglomerate world out on the West Coast for a number of years. He was living in communities that were really downridden, if you will, unsafe, and he felt that this was truly a market and environment, a demographic that was really being underserved, and it still continues to be today. So Max and his wife picked up back in late 2015 and moved themselves to Phoenix, Arizona. And here, with some of his workers, Max struck out and found a property at 16th Ave and Camelback and began to take the model at hand. He himself, along with his workers, bootstrapped, pulled cable, took these downridden properties, if you will, and in 2 to 3 years, stabilized these properties after taking out the boilers, reducing expenses, creating a safe environment, and improving the lives of these residents in and around an urban core area. So truly the model was set in stone there. And after 2 to 3 years, he refinanced and took out his original investors by the end of 2018 and provided them with 2.5 and 3.6x multiples on their funds. Some of them cashed out, some of them stayed in as Max began to purchase another property next door called Urban 93. Let's fast forward to the beginning of 2019 when he found an investor partner and began to take this model to a full growth mode. That's when Taylor and I joined in January and February, respectively, in 2019 to help raise the first 20 million and purchase the first 3 properties in Arizona. These properties we called Fund 1, and we successfully raised the 20 million by October of 2019. At that stage, we then decided to find local partners in other markets that were favorable. And we went and searched and found Detroit as one such market. What we did there was we purchased, and we'll come into that detail, a large neighborhood, and then we expanded from there into Oklahoma City. So you can see this model has taken hold. We're pivoting somewhat because initially we had set out to develop and redevelop very heavy value add and put a lot of CapEx in when the markets were more favorable at the cap rates and the gross multiples that were shown back in 2019 and 20, but things have changed. So we're now focused on more cash flowing assets in more stabilized markets while still providing our investors with great returns. Let's now talk about the workforce resident and what we mean by that. Taylor?
Thank you, Pete. So as Pete just mentioned, and one of the demographics that we heavily target here at Urban Communities is the gray collar workforce demographic. And what that basically means are a category of people that fall between blue collar and white collar jobs. We define them as people that make between $35,000 and $75,000 annually in the United States. And more formally, the Urban Land Institute defines this group of people as those who make between 60% and 120% of the area median income. So in other words, these are low to moderate earning people. They are typically hardworking, community serving citizens. At our properties, we see a lot of police officers, nurses, tradespeople, first responders, a lot of healthcare and government workers. They usually make enough money to be able to afford our rents at market rate. They typically do not qualify for government subsidies, and they usually are having a difficult time being able to afford luxury Class A apartments in downtown urban areas, essentially close to where they work. There's large demand of this demographic. They comprise, the workforce demographic comprises about 1/3 of all US-based renters. So there's ample opportunity for us at Urban Communities to improve lives across the country. And I'll turn it back to Pete for some market updates.
Thanks, Taylor. Yeah, now what we'd like to do is just turn the page a bit here and talk about the multifamily market and the industry as a whole, where we stand today. We've been through a lot. Everybody's been through a lot over the last 2 years. The pandemic threw a wrench into everything. Although with the infusion of the PPP program, the Federal Reserve truly opening up the coffers and providing liquidity to the markets and to every American, they were flush with cash, and that really sustained the growth. The economy does remain strong, even though it's come off the top. So what we're going to talk about now is the inflation. Definitely inflation is something that is of concern. So when everybody has noted that the Fed tries to keep inflation in and around the 2% level, well, with the infusion of cash over the last 2 years, this has grown exorbitantly, and we now have inflation hitting 8.3%. That may come off a bit in the coming month or two, but we don't think it'll come down to the 2% level for some time. So Fed Chairman Powell has his work cut out for him, trying to land this jet on this large aircraft carrier with precision. And some of the market feels that that will be tough. Some of the market feels that the recession may hit, but the strength of the economy still remains resilient. Growth is not necessarily at 25% plus as we've seen in the last quarter of 2021, but we are still at 10 to 15% growth expected throughout the year, and that's going to remain very strong. And as many of you know, inflation is considered a hedge here. Real estate is considered a hedge with inflation, and we're seeing that with also large conglomerates around the world flush with cash, wanting to find, if you will, a core hard asset, and real estate is one such asset class. Multifamily in particular is also a non-correlating aspect to what we're seeing here with the equity markets, as they seem to be in flux and people are taking profits here and there. That's the uncertainty that truly we're feeling in the equity market. So a nice side is real estate, and that's where a lot of the smarter money, if you will, is positioning in multifamily amongst all commercial real estate. Let's turn next to demand. What we're seeing here is with the pandemic, demand has really moved. A lot of people have moved from the gateway cities, really uncertain with the crowds, with the pandemic, with COVID. And so many of them have moved not only for lifestyle reasons, for safety, and also for tax reasons. And many of them have flooded in towards what we call the Smile States, and where we're now focused on in the Southwest and Southeast. We've seen construction in single family homes peak throughout 2021, but still the shortage remains, not only in home construction, but also multifamily construction. This year alone, demand is approximately going to be shortfall by about 600,000 plus units in multifamily alone. We're seeing peak housing prices as well. The US average house price is close to $400,000, and that's really pushing a lot of the Gen Zs, which is the largest population base and growing, not able to afford a new home price and to form a family. So the Gen Z, if you will, the population that was born in 1997 to 2012 are moving out of the gateway cities to more affordable places. We're also seeing that migration with baby boomers. Baby boomers who are now empty nesters are moving into the Vegas, the Phoenix areas. You can see the top 10 markets by population and the rental growth rates there. So demand is there with immigration as well, with the Gen Z and the population transitions, as well as baby boomers, and they're all migrating to these unique areas. Let's go to the next slide, please. Let's talk now about the multifamily market analysis. And what we're seeing in here, everybody, is the rent growth. These are the large green dots where it's north of 10+% in these markets. They've been quote unquote hot markets, pardon the pun, here in Phoenix. But we're seeing the growth stabilize, not necessarily the 10 to 15% rent growth that we've seen in these, especially in the Class A units. And those are the more, the late stage growth markets, the higher end rental units. Class B and C, where we focus, saw rent growth anywhere from 7 to 10%. So that's below the analysis of inflation at 8.3. So it's allowed our renters, if you will, and residents to be able to sustain and manage their expenses at home a little more. So we continue to see the migration away from the gateway cities to more favorable tax states, to more, if you will, where companies are migrating and moving to, with Amazon, Tesla, Google, all the, if you will, the new conglomerates and tech companies are moving to these more favorable tax states, where also the climate and the population base want to be to move in as well. Next slide, please. Let's talk now about the originations. This truly has been an exorbitant growth area. Right now, origination volumes alone in 2021 were up 25+% to 450 billion in multifamily across the board. A lot of those, again, are still continuing, although the growth is off now maybe to the 15 to 20%. We're going to still see originations in 2022 north of $500 billion. Houston alone was the third largest originator of growth and purchases, with close to 15 billion in Houston in the first quarter. That was the top 3 market here in the US in early 2022. Now, headwinds do remain with the potential increase in interest rates that Fed Powell is going to start moving on here in the next month or two, as we've definitely read in the papers and we're expecting him to execute on. But what's also interesting to follow is the foreign investment that is still growing. Conglomerates, sovereign state funds, pension funds around the nation, let alone around the world, from Canada, Europe, Saudi Arabia, and Latin America, want a place to position and start earning yield. They're not necessarily wanting the volatility in the equity markets, so they're looking to hard assets like real estate and commercial real estate, multifamily, to help them with these yields and with this growth forecast. And finally, let's talk about sort of the forecast going forward here on our last point, looking ahead. Looking ahead, folks, we're going to definitely see housing demand. We're still at a shortfall, as I mentioned before, of north of 600,000 units in multifamily alone here in the US. That forecast by CBRE by 2030 will be close to 4 million. Construction costs have been hindered with supply chains and costs across the board. Although lumber's coming back, we're still seeing, and we're able to, when we outsource and purchase, we're actually buying in bulk and storing in our warehouse or on site, refrigerators, windows, and so on. So we're actually looking ahead so that we can try to anticipate the supply chain that hopefully will open up, but is still very much a headwind going forward. Household formation will continue. The Gen Zs will want to start raising families themselves. They'll start need to rent. We all need housing, and especially this underserved demographic, giving them the ability to live close to where they work. With gas prices the way they are, they really truly want to be close to where they want to work in the urban market that they so choose. And then finally, future trends for growth remain strong. As I mentioned earlier, immigration, that is going to continue. We've seen that. Baby boomers scaling back, wanting a better lifestyle. They're looking to actually downsize and be in an urban core where they can be close to going out to dinner, seeing the arts, and being in part of that community. And then finally, the migration patterns away from the gateway cities will continue. So with that, let's turn a look to the markets that we're in right now. As I mentioned earlier, we focused in Grant and began in Phoenix back in 2000, officially back in late 2018, although Max began this journey back in 2015. And that market truly has grown. Although it's come off the bit, Tampa became the first this past quarter to lead the country in growth. Phoenix still was second and very strong, close to 25+%. We then branched out into Detroit, where we purchased a large community just northwest of downtown Detroit with a local partner there. And that is in a historical district called Palmer Park, which is just an incredible area just north of downtown, right next to the Detroit golf course and just south of the very affluent areas of Birmingham and Bloomfield Hills. The city itself is putting in $4.5 billion to really rejuvenate, if you will, the core area of Detroit after the pandemic. And Amazon purchased just less than a year ago the Michigan State Fairgrounds to build their largest distribution facility just less than a mile away from this neighborhood that we're redeveloping. So great growth forecast there and going to be a great project for us ongoing. And then finally, just before we closed out 2020, we purchased 358 units in Oklahoma City. That is developing itself. We're refinancing that project like Detroit, having the debt costs and getting our construction ready to go. And that's going to be also very fruitful as we're looking at other acquisitions in and around the Oklahoma City area. And then finally, we're coming into Texas. We're coming in there with a vengeance, an off-market deal that we'll highlight here momentarily with Taylor. And that's going to be in Houston with 3 properties. So you can see the other green states that we will be targeting, but we'll start doing that after we close on Houston and sell our Fund 1 properties here in Phoenix over the next 60 to 90 days. So a lot going on, but we're excited with this growth. And let's turn it over to this next offering here in Houston. Taylor?
Thank you so much, Pete. So before I jump into the offering, I just want to touch a little bit on why we are interested in Houston and why we see an investment opportunity here. As you can see from this graph, Houston is a stable market. It's one of the hottest real estate markets. It has been for decades. And it's also the second largest multifamily market in the country. So lease asking rents today are up 11.2% from last year for an average of $1,263 per unit per month, as this graph shows here in orange, mirroring the national growth. On my next slide here is just a visual for you to really see how Houston is keeping up with state and national rent growth in the last year. As I just mentioned, 11.2% rent growth is what we saw last year. The red line there is Texas. You can see both Texas and the US national averages are growing as well, which brings me to this next slide. So why are rents going up? The truth is people are moving to Houston today. Over 470,000 people moved to Houston in the last 5 years alone, bringing that MSA population to about 7.2 million. And that growth is expected to continue. About 600,000 people are expected to move to Houston within the next 5 years. So it's no surprise that people are moving here. It is the energy capital of the world, and the cost of living index also indicates that Houston is less expensive than the national average. So it's a great city to live in. It's a populous city, and the prices there in Houston are just a little bit below what you can get in some other cities. You get more bang for your buck. It is home as well to 24 Fortune 500 companies, more than any city in America, second only to New York. So there's a lot of energy, oil and gas companies, a lot of jobs are being created. We saw 5.10% job growth last year alone. That's expected to continue rising. Jobs are plentiful. On my next slide here is just a quick example of some of Houston's largest employers, a lot of oil and gas companies. As you can see, it's not super surprising that people are wanting to move there for jobs. Not to mention 250 people are moving here on average every single day. So the multifamily housing demand is through the roof. And for the second time in a long time, Houston right now is experiencing one of its lowest levels of housing inventory of all time. So just slightly above the lowest level it's ever experienced. There is ample growth in Houston for developments. There's ample opportunity to acquire assets at below replacement cost. And although the pandemic has hit a lot of economies here in America, Houston has remained relatively stable. It did as well during the 2008 and 09 crisis. It did not experience the effects that a lot of other cities, did experience during that recession. And so it's a stable market. We're looking to Houston not only for cash appreciation, cash flow, but equity growth and appreciation. We're able to see a lot of the properties in Houston are cash flowing properties. They're all likely to be 90% plus occupied, and the stats are just there. So it's a great city to be in, and that brings me to this next point and the final talking point in this webinar, which is our newest and latest investment opportunity in Houston. We're really excited about this one. It's completely off market. We have a local partner that we've joint ventured with who's based in Houston. He has been investing there with his family for many years and is very, very familiar with the markets in and out and the entire MSA. So we partnered there in Houston, and that is exactly how we found this deal. Our local partner there is longtime friends with the seller, and it's completely off-market deal. So we are looking at 3 apartment properties, 3 separate properties located in the Spring Branch submarket, the Langwood submarket, and the downtown Pasadena submarket. In total, that's 665 units. We're able to acquire all 3 properties in a portfolio for $77.2 million, which is about $116,000 per unit. So it's a great price point. And the other great thing about this deal is that all 3 properties have assumable Freddie Mac and Fannie Mae loans with 4-year terms left on the loans, and at an average interest rate of 3.33%, which we just aren't seeing in today's market. So that's really exciting. We are almost through the loan assumption process at Urban Communities, and our total loan to value that we're looking at for the portfolio is around 72%. So we have decent leverage, and these properties are fairly in really good shape. They're built between the 60s and 70s, so they're ripe for value add. And that's exactly what we plan to do. So we would like to buy, renovate, and stabilize the properties. Right now they have below average rents, and our plans are to upgrade all of the unit interiors. That includes adding things like new countertops, tile backsplashes, new laminate flooring throughout, new appliances and fixtures as needed. We'd also like to renovate the exterior and common area spaces. So something that we do a lot at Urban Communities is add yoga decks and community gardens and barbecue grills and new lounge and pool furniture to really activate the common area spaces in the communities so that we can host our events. As Pete touched on earlier, one of our signature value add plays is activating property management and really creating resident engagement through hosting resident events at our properties. And lastly, we will be remediating any deferred maintenance because of the year that these properties were built. They're a little bit older, as I mentioned. So what does that mean for our limited partners? Well, the business plan really is to, again, buy, stabilize the properties in 2 to 3 years after renovating them. We believe that after the 2-year mark, we will be able to either sell the properties to a private REIT, as Pete will touch on briefly, or to the market for a price that we're targeting of about $113 million as a portfolio deal. That's about $170,000 per unit. So we plan to buy them for $116,000 per unit on average and sell them for about $170,000 per unit. And that on the unit level means that we'd add about $16,000 in CapEx per unit to achieve this business plan. We are anticipating a target IRR to the limited partners in this deal of 32.85%, and we are anticipating an equity multiple of 1.76 and a cash on cash yield north of 7% on year 2. So overall, it's a very exciting opportunity for us. We are really hopeful about the Houston market, and its stability over the past decade has really given us confidence, paired with our leverage and our track record that Pete will touch on in a moment, that we feel confident we can execute this business plan. So I'll turn it over to Pete, and I do see that we have a few chats. So we will get to your questions during the Q&A. Thank you.
Yeah, I saw those come in. That's great. Thank you, everybody. So with regards to the track record, I'll just let you absorb it for a second, but highlight truly how these returns are coming. And it comes on a couple of factors. One, we're focused truly on the resident. And what I may not have touched on really before is that when Max created this business model back in 2015, he was very, very focused on the resident to make sure that they had a secure place to live, that they were truly improving the lives, and that they felt safe. And how he did that were twofold. One, as he created value and created the NOI, the net operating income, which is very important, obviously, to our investors into the business model. It was also taking expenses away from the resident that they would normally pay, such as internet, water, and so on, and take them upon ourselves, but then charge back so that we can increase the NOI while still maintaining a very favorable rent and market rent for that resident. But let me give you an example. One, where we can and where most of our properties have is one bill inclusive of all but their cell phone. So in markets like Phoenix, resident will come in, they will pay one bill, which will include their internet, the water filter, storage, etc. And we're able to do that as Max and the team here have gone out and found commercial rates, taken the internet and negotiated with Comcast or Cox. And for that resident not having to pay $120 themselves, they'll pay $120 to us, whereas we'll get a favorable commercial rate, which could be $70 or so on. So that unique spread, if you will, is indicative of the uniqueness that Max does. Giving you one more example is water. We noticed residents coming in with water that they were purchasing at Costco every month for $30. We'd go out and purchase water filters. So every unit would have a water filter. They would pay us $30, have clean water. We would pay $75 to purchase these overseas, install them, change the water filters out twice a year. So again, the nuances and the elasticity that we're able to take on to increase the NOI is proof in the pudding, and that we're getting these types of returns to our investors. So with respect to our investors, as Taylor alluded to, we focus on a 20% net IRR to our investors in a 2 to 3 year period. And once we stabilize the property, usually 6 to 8% cash on cash yields, we'll do two ways to sell this. We'll either sell it into the market, whereby we'll have a market rate bid, if you will, process. We feel we might know the asset well enough so that, in other words, we're going to start looking to create a private REIT by the end of this year. So that if we don't sell it out to the market that goes for 3 or 4x by some sovereign wealth fund or some very large group that wants to pay that multiple, we'll let it go if that's the case. But if not, we feel we'll know the asset well enough that we'll do a reverse auction by the SEC, go out and find the best price and buy it into the private REIT. At that point, the investor will have three options. The investor can either up-REIT into the REIT and get a cash deferred yield, 6 to 8%. We've essentially doubled their money, so it will be closer to 10+% and have a diversified income stream as we're going across the country with various properties. Or they can cash out and do what they will with their proceeds, or do a combination of both. So that's the business model we're looking at going forward. But as we look at these returns, they speak for themselves. Urban 188 and 93 have just been sold in January at very favorable multiples of 2 to 3+X. Urban 128, 148, and 357 are out and under contract right now to sell. 128 is under contract and should close in the next 45 days. Urban 148 is about to go under contract, and Urban 357, we do have large institutional interest, and there's still some uniqueness there that we may recap that ourselves and continue to get great returns while cashing out existing LP investors, or if they'd like to stay on, they can. So hopefully that shows you where our growth is and what our track record states. Let's now turn over to some questions that you've kindly put into the chat box. And before we do, there's our disclaimer for the SEC that we make sure that all investors are shown. But just before we go to the chat room and you can see a couple of those questions there, Taylor. Let's look at one that came in earlier. Who can invest and how can they invest? Taylor, do you want to answer that one?
Sure. This one was submitted online. So this particular offering in Houston is a 506C offering, and that means that we can only accept funds from accredited investors. And if you are not sure what an accredited investor is, the most simplest term or definition as defined by the SEC is a person who has $1 million net worth, excluding their primary residence, or somebody who makes $200,000 or $300,000 with their spouse. They did so the last 2 years, and they expect to make the same or more in the following year and the upcoming year. There's other definitions and ways that you can be considered an accredited investor, and I refer you to visit the SEC website to check those out.
Great. And one other question can you address to here? When does this deal close for Houston, Taylor?
That's a great question. I don't think I covered that. So right now we're targeting a July 5th closing date, so just about a month from now.
Great. One question online that came in from David. Thanks, David, for this. What is the average age of these assets in Texas? I believe the vintage, just correct me if I'm wrong, Taylor, are the 70s and 80s. Can you just clarify that?
It's a great question. Actually, the late 60s and early 70s. There are 3 properties, so they're
great. And then, David, you have another question here. Let me address that one. How are you getting 72% leverage? So we are assuming, as Taylor mentioned, the debt. We are actually under contract with a term sheet right now with a pref, a soft pref provider. So that provider will be coming in with 25 million of the call it 38 million that we're looking to raise in this equity. We currently have funded approximately 3 million. We've got soft commitments of another 2 to 3 million. Plus, we have one large family office equity group that's coming in with a $10 million equity check. So that's going to be finalized here in the next week or two. So that actually leverage, just back to your point, David, that actually increases north of 80%, but that actually is enhancing those returns, as Taylor mentioned, with those target IRRs up into the 30s. But we always like to sort of state our factor as we're focused on 20% net IRRs, but this one with the leverage on the pref equity will give us a nice return there for our LP investors as well. One question here from Bob. Are you experiencing any supply chain issues in Detroit for building materials and appliances? Great question, Bob. I can't answer that specifically today, but I think across the board we have. That's why our procurement team and the construction team have definitely made large bulk purchases and are housing refrigerators, windows in our warehouse locally there. So on every site and property, we have a woodworking shop, a warehouse where we do store these so that we can get these in bulk and in time. But we're seeing a 2 to 3 month delay across the board, and this is across the sector that we even talked to with some of our peers. But great question. And one last question here. Let's just focus here. You mentioned how we can invest. We saw that question. What are the risks that I'm missing? That's a great question, everybody. I think the risks are how do you position your funds in a volatile equity market right now? You should obviously be well diversified is one question. So I think real estate, like a fixed income instrument, should be one part of a person's portfolio. Real estate is part of that sort of fixed income bucket. The principal is safe. The only risk you might have that I've even talked to the mentors of mine in this industry is that if the market continues to weaken, you just hold on to the asset that much longer. We're not going to have a forced sale, but you still get that preferred return of 7% on this Houston deal and the preferred return that you are in other deals before we sell that asset. That's kind of the only long-term risk and the shorter-term risk that we foresee in this market, but great question. And I think there's one other question, Richard, coming in here now. What type of regular reporting do you provide, and what are the terms of the fund? Okay, we'll talk. Taylor, why don't you talk about the performance, and then I can talk about the terms.
Absolutely. So regular reporting, every quarter, we provide our investors with a quarterly report to see all the financials of the properties that they are invested in, the funds that they're invested in. Pete and now myself that I've joined the investor relations team like to also send emails out on a regular basis, and we are always available for answering questions or phone calls that our current and prospective investors have. That's something we're actually working on right now as a team, is improving our reporting process, getting more frequent reporting out, and we're experimenting right now with monthly newsletters And we also have an investor portal, Juniper Square. That's a phenomenal portal. Our investors can log in at any time and see how our assets are performing and how their investment is doing. So we're constantly striving to improve there in the reporting process. It went from a team of 1 to a team of 2 now in the investor relations. So we are lean but mean and always available for our investors whenever they have questions.
That's great. And then the final part of that question, Richard, what are the terms of the fund? I'll make sure that we email you out the prospectus and you can see this, but it's a 7% preferred return pari passu, and then up to 15%, it's a 20% promote, up to 18, it's a 30, and then over 18, it's a 35% promote. So very much an industry standard institutional waterfall that many are familiar with, and we can answer those again in more detail as needed. So with that, let's be respectful of everyone's time. Thank you. We're just a little over our 30 minutes, but first, Taylor, thank you. Ladies and gentlemen, thank you all. Investors, I sincerely appreciate your confidence and trust in us here at Urban Communities. Those are new to our business model and to our updates today. We welcome more discussion with you, and if you'd like to consider investing with us, we'd love to talk you through the strategies, the offerings. We'll continue to have these monthly where we'll bring in industry experts. We'll bring in some of our team to talk through where we're at on some of these developments. But again, so thank you so much for our first inaugural webinar. We're grateful, and we'll now close out. Thank you so much.
Thank you, Pete. And our contact information is here if anyone would like to get in touch with either Peter or myself. These are our emails. You can also check out our website, join our investor list, and we will be sending out this webinar recording to everyone who registered today, as well as putting it on our website if you'd like to access it in the future. So we look forward to keeping in touch with everyone that joined. Thank you.